Michael Burry, money manager who in 2008 had correctly predicted the housing market collapse, is now betting 90% of his portfolio on a market downturn. Security Exchange Commission filings cited earlier this week, Burry is making his bearish bets against the S&P 500 and NASDAQ 100 at the end of the second quarter. Burry's investment fund has acquired put options during the quarter. These options have a total value of $739 million and are linked to the well-known Invesco QQQ Trust ETF. Also, the fund has obtained separate put options valued at $886 million, providing protection against the SPDR S&P 500 ETF. This could serve as both a warning and a piece of advice for countless global investors who track Burry. He accurately predicted the lending crisis and greatly benefited from the market decline. But the question is Michael Burry right about the US stock market again? Despite gaining fame for his role in The Big Short because of his accurate assessment of the 2008 housing market, Michael Burry has also made incorrect predictions in the past. He has a track record of retracting his inaccurate forecasts. In fact, starting from 2015, each time he made bearish predictions, the S&P 500 actually saw positive growth. Here's a rundown. In December 2015, he warned of a stock market crash, but the S&P 500 rose by 11% in the following year. In May 2017, he predicted another financial collapse, yet the S&P 500 increased by 19% over the next year. In September 2019, he anticipated a stock market crash due to an indexed ETF bubble, but the S&P 00 gained 15% in the subsequent year. In March 2020, he consistently held a bearish view, but the S&P 500 surged by 72%. In February 2021, he forecasted significant stock market declines due to a speculative bubble, yet the S&P 500 increased by 16% in the following months. In September 2022, he predicted more market troubles and that the market hadn't hit its lowest point, but the S&P 500 performed positively, gaining 21%. In January of the current year, he foresaw a recession and a new cycle of inflation, yet the S&P 500 achieved remarkable positive performance. Considering this history, let's refer to past events to gain insights into whether the investor famous for The Big Short is accurate in his current assessment. Years with high returns for the S&P 500. Since 1928, the S&P 500 has seen positive annual gains of plus 10% or more, an impressive 55 times. However, within these positive years, there were 23 instances of corrections where the index dropped by minus 10% or more. Additionally, over the same period, up until now, the stock market has had 34 years of positive performance with gains of plus 20% or higher. Surprisingly, even in these strong years, the market faced corrections of minus 10% or more at certain points. Let's take a look at the years when the S&P 500 achieved annual performance gains of plus 20% or greater. 1933, returns plus 50%, correction minus 29.4%. 1935, returns plus 46.7%, correction minus 15.9%. 1928, returns plus 43.8%, correction minus 10.3%. 1975, returns plus 37%, correction minus 14.1%. 1997, returns plus 33.1%, correction minus 10.8%. 1955, returns plus 32.6%, correction minus 10.6%. 1936, returns plus 31.9%, correction minus 12.8%. 1980, returns plus 31.7%, correction minus 17.1%. 1950, returns plus 30.8%, correction minus 14%. 1938, returns plus 29.3%, correction minus 28.9%. 2003, returns plus 28.4%, correction minus 14.1%. 1998, returns plus 28.3%, correction minus 19.3%. 2009, returns plus 25.9%, correction minus 27.6%. 1943, returns plus 25.1%, correction minus 13.1%. 1999, returns plus 20.9%, correction minus 12.1%. 1982, returns plus 20.4%, correction minus 16.6%. Interestingly, this year, the most significant drop the index experienced was only about minus 8%. between February and March. In comparison, our current corrections are relatively milder. It's important to remember that stocks can be highly unpredictable, much like the twists and turns of a roller coaster, influenced by impulsive decisions made by investors. Also, let's recall that in the latter part of the previous year, almost everything performed well except for tech stocks, which faced challenges. Then the market shifted its attention back to tech and larger cap stocks. As for the market's next move, it's an interesting puzzle to solve, especially given the recent decision by Michael Burry to short the market. When we compare the technology sector, NYSE to the S&P 500, we see that it has been moving sideways for a few months, breaking its previous upward pattern. The Relative Strength Index, RSI, confirms this tech sector's weakness. But looking at history, there's a chance it could recover momentum, just like it has done before. Interestingly, things might be even worse for the energy sector, NYSE when compared to this situation. Since 2020, the energy sector has notably lagged behind in terms of performance this year. Surprisingly, it has even outperformed the tech sector in the past month. Once more, the Relative Strength Index, RSI, supports the idea of weakness in the tech sector. In comparison to the Growth Index, NYSE, the energy sector is exhibiting a favorable change, recapturing levels seen in March 2023. This decline in strength holds significant importance for market analysts, especially considering that technology and large cap companies account for more than 30% of the S&P 500. If they are encountering temporary struggles, it might lead to difficulties for the broader index. So does this mark the end for the tech sector? I don't think so, but these observations indicate that there could be a shift taking place. Once more, the ratio between the S&P 500 and Invesco DB Energy Fund, NYSE has faced a barrier, causing a delay in the US index's superior performance in comparison to the energy index. On a different note, the stocks that make up the FANG Plus index have started to decline following their peak in 2021, meeting resistance from the previous cycle. However, history might not repeat itself exactly. The decline in 2021 had different causes. Watching how the markets move will be really important in the next few weeks. In reality, I don't think the second scenario is very likely to happen before the end of this year, and maybe not even in early 2024. Regarding the US retail sales data in July, it showed a decrease of -0.12%. This kind of two-year flat trend has been linked to economic recessions before. The US retail sales report offers some really important insights into how both large and small businesses in the retail sector are performing. Economists and investors in financial markets closely follow this indicator because it indicates trends in consumer demand. Considering that approximately 70% of the US GDP is driven by personal consumption, any stagnation or lack of movement in this data needs to be carefully observed. Furthermore, there's the SHIM indicator, which suggests that the economy tends to enter a recession when the quarterly moving average of the unemployment rate rises by 0.5% compared to the lowest point over the past 12 months. This indicator, introduced in 2019 from a study by Federal Reserve economist Claudia Sahm, is perhaps the most real-time tool we have to monitor recessions, even though the National Bureau of Economic Research typically takes about a year to officially declare a recession. Currently, the quarterly moving average of the unemployment rate has only increased by 0.1% compared to the year's low, far from the 0.5% threshold that indicates a recession. Looking at the chart, we can notice a pattern where unemployment frequently hits a low point in this cycle, just before a recession, and then rises above 4% during the economic downturn. Presently, it's at 3.5%, close to the lowest level in the last 50 years. Could this potentially indicate an upcoming recession in the following months? So the question remains, will Burry, who recently disclosed his short position on the market, prove correct this time, or will his prediction turn out to be inaccurate once again? Only time will provide the answer. However, historical trends might not be in his favor this time. Burry's tweet drew a lot of comments on social media. Some users pointed out that the year had been very bad for the stock market, while others were convinced that a crash was imminent. There are bunches of ways you can help protect your investments in case the market takes a tumble. Stick with strong companies. It's a good idea to invest in big, well-known companies that are in industries that tend to grow over the long term. These kinds of companies usually do better when the market isn't doing so well. Keep some cash. Having a part of your money in cash means you can use it to buy stocks when their prices are low during a market crash. Try covered calls. This one's a bit more complex, but it involves selling an option that lets someone else buy your stocks at a set price before a certain date. It can give you a safety net if the stock's price goes down. Go for dividend stocks. These are stocks from companies that pay you a bit of money regularly. Even when the market is down, these payments can help keep your spirits up. Spread things out. Don't put all your eggs in one basket. Invest your money in different things like stocks, bonds, and different industries. This way, if one thing goes down, the others might still be doing okay. Check out inverse ETFs or put options. These are a bit advanced, but they're like betting against the market or certain stocks. They can be like a safety net if things go bad. Consider precious metals. Investing in things like gold or silver can be a good move because their value doesn't usually swing as much as stocks do. Stay in the know. Keep an eye on what's happening in the economy, the market, and the world. That way you can make smart choices about your investments. Cash flow, powerhouse, and stock repurchases. Alphabet. While many stocks tend to decline during market downturns, Alphabet, traded as GOG and Google, stands out with its unique ability to capitalize on such situations. The company generates an astounding amount of free cash flow, an impressive $71 billion in the past year alone. This financial strength empowers Alphabet to execute substantial stock buybacks, having already utilized $60 billion for this purpose as illustrated below. Google is using some of its money to buy back its own stock, which adds up to 3.5% of its total value in the stock market. If a stock price goes down, Google can buy even more of its shares for the same amount of money. This would make the stock go up even more when things get better, giving shareholders better returns. Despite rumors that Google is losing its edge, it's actually doing well. Its earnings, profits, and the money it has available are all up this year. Google Search is still way ahead with an 85% share of the market. They're also doing a lot with artificial intelligence. Their Google Cloud service is growing fast, and the people in charge are all about making things work better. Conclusion. Simply put, Michael Burry often has a negative view of the market, but the fuss about his purchase of put options is blown out of proportion. Meanwhile, the Triple Q, which has gained 37% this year, seems a bit expensive. This is especially important if you believe we might be heading for a recession. It's quite possible that he's using a strategy called a short straddle. This involves selling a call option while also buying a put option. Instead of taking a huge $1.6 billion risk without protection, which doesn't match his usual cautious approach, he usually takes positions with much lower risks like 50, 80, or 100 basis points. This suggests that he's not really a high-risk trader. It's likely that he's using a short straddle in this case. The interesting part is that the reports don't have to reveal the other part of the trade, where he's betting that the price will go down being short on a call option. So this might not be as dramatic as it seems. The hype could be more about the lack of other big news right now rather than something really significant happening. But to protect your long-term investments without trying to predict exactly when the market might dip, you can do a few things. Keep some cash, sell call options, and invest in strong companies that are making good money. These steps will help you come out even stronger after a possible market slowdown. What's your take on Michael Burry's trading strategy and his recent moves in the market? Feel free to share your thoughts on the situation in the comment section. If you found the video helpful, remember to subscribe to my channel. Thank you.